What would a sudden 25% tariff on major European partners do to your portfolio? And why is Greenland even part of this conversation? Former President Donald Trump has floated the idea of imposing steep tariffs on 8 European countries if the U.S. doesn't move forward with acquiring Greenland. It's a provocative blend of economic pressure and foreign policy, and it raises real questions for markets, businesses, and investors. Here's the context. Tariffs are usually used to protect domestic industries by raising the cost of imports. Using them as leverage in geopolitical negotiations is less common, but it fits a broader pattern of prioritizing economic tools over traditional diplomacy. The targeted countries were not named, and no policy has been enacted. Still, the signal alone can move expectations and prices. There are several implications investors should watch. If tariffs materialize, import costs could jump across categories that rely on European inputs, from autos and luxury goods to machinery, pharmaceuticals, and specialized components. Companies with transatlantic supply chains may see margin pressure, either absorbing higher costs or passing them to consumers. That can slow sales, dent earnings forecasts, and pressure valuations. Retaliation is another risk. Europe could respond with counter-tariffs that hit U.S. exporters in agriculture, industrials, and consumer brands. Even the prospect of tit-for-tat measures can chill investment plans, delay capex, and widen bid-ask spreads in affected sectors. Markets tend to price uncertainty quickly. Equities in trade-sensitive industries may swing, while safe haven assets and the dollar can catch flows depending on the narrative and central bank stances. Policy uncertainty also complicates currency moves. A stronger dollar on risk aversion can weigh on multinational earnings when foreign revenues are translated back, while a weaker euro could help European exporters but signal stress for domestic demand. Credit markets may reprice risk for companies most exposed to cross-border revenue and costs. Finally, the Greenland angle underscores a shift toward unconventional linkages between security interests and trade actions. Investors should expect headlines to move from sanctions to tariffs to investment screening, sometimes within the same news cycle. That keeps volatility elevated and shortens planning horizons. What can you do now? Map your exposure to Europe-reliant revenues and inputs. Stress test margins with higher landed costs. Consider selective hedges for FX and rates. Focus on businesses with pricing power, diversified supply, and clean balance sheets. And avoid knee-jerk moves. Wait for clarity on scope, timing, and exemptions before making big allocation changes. For a deeper breakdown and sector-level scenarios, read the full article at finlitica.com.